Learning objectives. After studying this module, students will be able to understand the concept of stakeholders, distinguish between capital and revenue, state financial statements, understand the need of preparing financial statements, explain trading profit and loss accounts and its relevance. Items to be included in trading profit and loss account. Marshalling and grouping of assets and liabilities. Stakeholders and types. What is financial accounting? It is a structured record of financial activities of a business that defines the position of a business, person, or other entity. We all know that the main objective of the business is to provide important financial information to the investors, stakeholders, so that they are well informed about the position of the organization while taking business decisions. Who is a stakeholder? A stakeholder is the person who has interest vested in the business. They get impacted by the various decisions in the organization. The stakeholders can be internal and external depending upon the financial information they require from business. The stakes of the stakeholder can be divided as monetary or non-monetary, active or passive, direct or indirect. Let us discuss the internal and external stakeholders. Internal stakeholders. Let us discuss the internal users of a business. Current owners. They want to invest in the business for growth of the business. They like to know the assets and liabilities of a business and paying capacity of the business, profit of the business, before making any investment in it. Manager. They are employees of the business that work on behalf of owner. They work in the business to learn and to succeed in their careers. Their duty is to know about the profit and loss of the business and the financial position of the business because their promotion, appraisal depends upon that. External stakeholders. Government. A government specifies the rules for that a business needs to follow and make sure that they work for public interest. A government is interested whether the tax is paid to the government on time, whether rights of the investors are protected, what is the profitability of the business. Prospective owners. He has not invested in the business but can investment in the business for money making. He is interested in knowing the financial stability of the business, last year's profits, and what the chances of future growth are. Banks. Banks provides loans to business, so they want to ensure the timely payment of principal and interest. They want to know the profits of the business and liquid assets of the business before lending loans. Capital and revenue. Difference between capital and revenue. There is major difference between capital and revenue when it comes to accounting. It helps in making trading and profit and loss account of a business. The items that come under capital are displayed in balance sheet, whereas revenues of a business are shown in trading and profit and loss account. What is expenditure? An expenditure is the fund used by a business, organization to attain new assets or to improve the already existing assets or to fulfill a liability. These are the use of funds or resources for the day-to-day operations of a business. like giving salaries to the staff, payment of rent, etc. The benefit of expenditure can run for one accounting period or more. These are the expenditure whose benefits can extend up to one accounting period and expensed immediately. They are known as revenue expenditure. These are the expenses whose benefit can be attained for more than one accounting period and which are to be productive for a long period of time, known as capital expenditures. Difference between capital expenditure and revenue expenditure. Earning capacity of business. Capital expenditure helps to increase the earning capacity of a business, whereas revenue expenditure helps to maintain the earning capacity of a business. Purpose of expenditure. Capital expenditure is done to buy fixed assets for smooth operation of business, whereas revenue expenditure is done for the day-to-day operations of the business. Nature of expenditure. Revenue expenditure is recurring expenditure by nature, whereas capital expenditure is non-recurring by nature. Benefit extension. The benefit of capital expenditure extends more than one accounting year, whereas the benefit of revenue expenditure extends for one accounting year. Recording of expenditure. Capital expenditure is showed in balance sheet, whereas revenue expenditure is transferred to trading and profit and loss. Importance of capital and revenue expenditures. What is deferred revenue expenditure? The revenue expenditures whose benefit may extend for more than one accounting period are known as deferred revenue expenditure, like advertising expenditures. What is the difference between expenditure and expense? Expenditure is funds spent by the business firm on the day-to-day operation or purchase of assets or paying off any liability, whereas the part of the expenditure which is used or incurred in the current year is termed as expense of the current year. Receipts. These are the receipts that are not received again and again and are required to return. The benefit of these receipts can last for longer periods. These are called as capital receipts. The example is a loan taken from the bank. These receipts are received again and again and do not give an obligation to return the money, called as revenue receipt. These receipts are required to meet daily expenses of a business. The examples of such receipts: interest on investment received by the business. Why it is important to know the difference between capital and revenue? It is important to know the difference between the capital and revenue for the following reasons. We know that all revenue items we show in the trading profit and loss account and capital items are to be shown in balance sheet. If any item is wrongly entered in the books of accounts, then the calculations of profit and loss account would be incorrect. So, it is important to identify the correct nature of each item and enter it accordingly in the books of accounts. To know the exact financial position of a business, it is important to classify these items correctly and put these items in the correct header. It is also important from taxation point of view because capital profits are taxed differently from revenue profits. Financial statements and its objectives. Financial statements. All the users, whether internal or external, have different informational requirements from the business. So instead of generating information for individual users, the business prepares a set of financial statements, which fulfills the informational needs of all type of users. Objective of preparing financial statements. Financial statements gives a true and clear picture of the financial status of the business or organization and change in the financial position of the business over a period of time. Financial statements give a true and clear picture of the financial performance of the organization by doing a comparative analysis of the previous performances. Trading and profit and loss account. Trading and profit and loss account are generally prepared together. It helps to calculate the profits earned by the business in one accounting period and loss faced by the business in an accounting period. It helps to calculate the net profit or loss of the business in one accounting period. It is a summary of revenue and expenditures of a business. The debit side of the trading profit and loss account shows expenses and losses, and credit side shows revenues or gains. Items in trading profit and loss account. Items on the debit side. Opening stock. It is the goods in hand which are available for sale in the beginning of the accounting year. It has been carried forward from the previous year. Purchase less return. On the debit side of the trading account, we write the goods that has been returned to the seller. It may be cash or credit. The goods which a buyer returns to the sellers are termed as purchases return. We show it by deducting it from the purchases, and the net amount is known as net purchases. Excessive purchase returns can affect the profitability of a business. Items of trading profit and loss account. Wages. This is the amount paid to the employees who are directly involved in production process of the business, like loading and unloading of goods, transportation of goods, and are debited to trading account. Carriage inwards. It involves the expenses done by the business for transportation of goods from a supplier to business and business to customers. Fuel, water, power. These are the expenses which are incurred during the process of producing goods and are considered as the part of the expenses. Packaging material and packaging charges. The expenses that are incurred for packaging of goods to make them ready for sale or for transportation purpose or for safety of the product considered under packaging charges. The cost of material that is used in packing of products are called as direct expenses, whereas the expenses that are incurred on transportation of goods are known as indirect expenses and debited to trading profit and loss account. Rent, commission, interest paid. This includes the expenses incurred as office rent, go-down rent, factory rent, taxes, interest paid for loans, bank overdraft, etc. Commission to paid agents for business transactions and are debited to profit and loss account. Repairs. All kinds of repairs that are relating to furniture, fixtures and repairing of plant and machinery are included under this head. Such expenditure is debited to profit and loss account. Miscellaneous expenses. The expenses that are in small amounts are clubbed together and known as sundry expenses. These expenses do not come under any head of expenses, also called as trade expenses. Items to be entered on the credit side. Sales less returns. The goods that are returned to the seller by the customers are called sales return or inwards returns. These are deducted from total sales so that net sales can be calculated. It can be cash or credit and showed in the credit side of the trading account. Other incomes. All other types of incomes and gains are recorded in the credit of profit and loss account. Examples of such incomes are rent discount, dividend interest received, etc. Concept of gross profit and net profit. The trading profit and loss. Account is an account which is made of two accounts, trading account and profit and loss account. The trading account helps to find out the gross profit or gross loss during the accounting period, whereas profit and loss account helps to find out net profit or net loss during the accounting period. Trading account. The trading account finds out the output from the day-to-day operations of the business. These operations can be manufacturing of goods, purchasing and selling of goods. Trading account is prepared to find out whether the selling of goods and services to customers is profitable for the business or not. The business expenses are divided into two categories. Direct expenses. Direct expenses involve all the expenses directly connected with the business part, like manufacture, purchase of goods, and bringing them to the selling point. Indirect expenses. Indirect expenses are those expenses that are incurred to operate a business as a whole or part of the business and are not directly associated with the business. Gross profit. We know that the sale is the main source of revenue for the business. The excess of sales over purchases and direct expenses is called gross profit. Gross profit is the amount of revenue left after deducting the costs of making a product. When amount of purchases and direct expenses is more than the sales, the result is gross loss. Net profit. It is also known as net income or net earnings in a business. It is the profit of a company after deducting operating expenses and all other charges from total revenue. When the total revenue is more than the all operating and other expenses, then there is new profit, else net loss. When the total of the credit side of profit and loss account is more than the total of debit side, and then it is called as net profit. When the total of the debit side is more than the total of the credit side, the difference is called as the net loss. Closing stock and cost of trading. Cost of goods sold. Cost of goods sold is the cost of material used in manufacturing a good along with direct labor cost to produce the goods. In the absence of opening or closing stock, the total purchase and direct expenses are considered as cost of goods sold. Closing stock. The unsold goods at the end of the accounting period are called as closing stock. Let us assume that out of the goods purchased amounting to 95,000 in the current year, Arun is able to sell goods costing 50,000 rupees only. In such a case, the business will have an unsold stock of goods costing rupees 45,000 in hand, which is called as closing stock. Operating profit Operating profit is the profit of a business before deducting the taxes and interest. It is a profit that we earn during the normal operations of the business. It is the excess of operating revenue over operating expenses. In operating profit, the loss by abnormal causes are not considered. Balance sheet. The balance sheet is the most fundamental financial document that reveals the company's total assets and liabilities. It tells us about the financial position of the business at the end of an accounting period. Debit side of it shows assets and credit side shows liabilities. It is a statement of balances of ledger accounts that are to be carried forward for the next year rather than transferring into trading profit and loss account. That is why it is called a balance sheet. Balance sheet. Preparing balance sheet. There is not specific format for preparing balance sheet. Schedule 4, Part 1 of the Companies Act 1956 prescribes the format and the order in which the assets and liabilities of a company should be shown in a balance sheet. On the left side of it, we show all the liabilities and capital, whereas on the right side, we show all the assets and other debit balances. Items in the balance sheet. Current assets. The assets which are either in the form of cash or expected to be converted in cash within 1 year are known as current assets. The examples of such assets are cash in hand, stock of raw materials, etc. Current liabilities. These are companies' debts or obligations which are due and which are to be paid within a year. These are generally paid out of the current assets. The examples of such liabilities are bank overdraft, bills payable, etc. Fixed assets. The assets that are purchased for long-term use in the business and cannot be converted into cash instantly. For example, land, building, plant, and machinery, etc. Intangible assets. The assets that are not physically present in front of us and that cannot be touched or seen are called as intangible assets, like patents, trademark, goodwill, etc. Investments. These are the funds that are invested in the business with the hope that it will generate income in future. For example, the funds invested in government securities, shares of a company. They are shown at cost price. Long-term liabilities. These are the liabilities that are not due within 1 year of the date of the balance sheet. Examples are long-term loans from banks, pension obligations, etc. Capital. It is the amount invested in the business originally contributed by the partners to purchase assets. Drawings. The amount withdrawn by the owner in a business is known as drawings. It is shown by way of deduction from capital in the balance sheet. Marshalling of assets and liabilities. Purpose of accounting. The main purpose of accounting is to prepare the financial statements and presenting the financial statement in such a way that it gives the clear view of the financial position of the organization. The information provided in a financial statement should be useful for the stakeholders and decision makers. So, it becomes necessary that the items appearing in the balance sheet should be properly grouped and presented in a proper order. Marshalling of assets and liabilities. The term marshalling means the order in which the assets and liabilities are arranged. The process of arrangement of assets and liabilities in balance sheet in a specific order is known as marshalling. The arrangement of assets and liabilities can be done in two ways. Permanence. In permanence arrangement, the assets and liabilities are arranged in the order of their life in a business. The most permanent asset or liability is displayed on the top in the balance sheet, and after that, the assets are arranged in their reducing level of permanence. For example, in the given balance sheet, you will find that furniture has more life in the business among all the assets. Out of debtors, bank and cash, debtors will take maximum time to convert back into cash. Bank is less liquid than cash. Cash is the most liquid of all the assets, whereas on the liabilities side, the capital is the most important source of finance that will remain in the business for a longer period than the long-term loan. Creditors are a liquid liability which will be discharged in the near future. Marshalling of assets and liabilities. Continued. Liquidity. Liquidity implies convertibility into cash. The information presented in liquidity manner would enable the user to have a good idea about the life of the various accounts. The assets, which can be easily converted into cash, would be placed at the top, whereas the liabilities are arranged in the order of payment. The most urgent payment is to be placed at the top of the balance sheet. Grouping of assets and liabilities. Grouping means putting together all the items that are of similar nature and put them under a common heading. The items that are displayed in the balance sheet can also be properly grouped. For example, debtors, bank, cash, etc. can be grouped and shown under the heading of current assets, and creditors can be put under the heading current liabilities. Opening entry. The balances that is brought forward from the end of one accounting period to the beginning of the another accounting period is called as opening balance or opening entry. In fact, the balance sheet of an accounting period becomes the opening trial balance of the next accounting period. Summary. Let us summarize what we have learned in this module. A stakeholder is a person associated with the business. The stakes of various stakeholders can be monetary or non-monetary. The stakes can be active or passive, or can be direct or indirect. The payment and or incurrence of an outlay are made for a purpose other than the settlement of an existing liability is called expenditure. If the benefit of expenditure extends up to one accounting period, it is termed as revenue expenditure. If the benefit of expenditure extends to more than one accounting period, it is termed as capital expenditure. The part of the expenditure which is perceived to have been used or consumed in the current year is termed as expense of the current year. The basic objectives of preparing financial statements are: A. To present a true and fair view of the financial performance of the business. B. To present a true and fair view of the financial position of the business. Direct expenses means all expenses directly connected with the manufacture purchase of goods and bringing them to the point of sale. The excess of sales over purchases and direct expenses is called gross profit. If the total of the credit side of the profit and loss account is more than the total of the debit side, the difference is the net profit for the period of which it is being prepared. If the total of the debit side is more than the total of the credit side, the difference is the net loss incurred by the business firm. Operating profit in the excess of operating revenue over operating expenses.